Today we're talking about one of the hottest topics in real estate right now, interest rates. Last Friday, markets reacted after Federal Chair Jerome Powell spoke at Jackson Hole, hinting at a possible rate cut this September. Rates dipped, but what does that really mean for your buyers and the agents between now and then? To help break it all down, I'm joined by our Chief Operating Officer here at Morgan Financial, Joe Harris. This is Lindsay Shellhorn, and this is Keeping Your Real Estate Business on Track. Hey, Joe, welcome back.
It's good to be back. It's been a while.
It has been a while, but I thought that it would be important to have you on this week specifically because a lot's been going on this week.
Yeah, it's been a pretty busy week. Last week, obviously, we're going to talk about Fed and the Jackson Hole stuff, but it's an exciting time to be in the mortgage and real estate industry right now.
Yeah. I mean, with that conversation that happened with Jerome Powell, I think a lot of people are kind of curious as to which direction is this going to go? What does this mean for us? So thank you so much for joining us today, because I think we can answer some questions and help people have educated conversations to help guide their clients too.
Yeah, and interest rates are an important topic because it's the cost of money. It's the cost that they're borrowing. It's going to influence the cost of their payment and what they can afford elsewise. So this is very important stuff right here.
Educated conversations with your clients.
Yeah.
So last Friday, we'll start there. What exactly did Jerome Powell say at Jackson Hole that caused rates to dip?
Okay, so let's just go back a step. The Federal Reserve, Jerome Powell's the chair of the Federal Reserve. The Federal Reserve doesn't directly impact the price of first mortgages, right? So, they do directly impact the price of car loans, of home equity lines of credit, like a HELOC, a second mortgage. They impact the credit card borrowing costs, student loan costs, prime rate, things like that. And so last week, after the last Fed meeting, usually it's customary that he gives a speech at the Jackson Hole after, one of the meetings. And in this speech, for the first time, he was slightly dovish. And dovish means that they lean towards dropping the interest rates. Hawkish means that they have a bias towards raising rates or keeping them the same. And so Jerome Powell has been very hawkish or in the middle. And this is the first time experts will tell you that he leaned more towards the openness to drop the Federal Reserve funds rate, the federal funds rate at the September FOMC meeting, the Federal Open Market Committee meeting that dictates what these rates do.
You said first time in a long time. How long has it been?
I mean, it's been, let's put it this way, we raised rates for like 11 or 12 times in a row.
Wow.
11 or 12 meetings in a row for years. Yeah. I mean, for literally 2 or 3 years, we raised rates and kept them the same. Now, right before the election last year, they dropped the rates 50 basis points, but that was the last drop we had. And then for the last several meetings this year, it was all about the tariffs and let's see what they do. But the reality is that here's where we are now, is that the Fed is now indicating, and this is the big news, that Jerome Powell, he says he's open to future rate cuts, as early as September.
Wonderful. So it has been a minute.
It's been a hot minute.
So from a buyer's agent perspective, why do markets react so strongly whenever the Fed has speeches like this?
Because, obviously they want to insight, all these, market experts, analysts and whatnot, they want insight to what the Fed's going to do. And so he is very careful. Jerome Powell is very careful with his language to not say something to overheat a market.
Incite a riot.
Or do the opposite.
Yeah.
But I'll tell you, I watched his speech in real time right next to what's called the mortgage-backed security market. I have real-time data that shows me what that market is doing. And you could watch, it hung on every word. But the rates got significantly better on Friday because of what he said, because they're forward-looking. So you asked, why does the market watch and hang on every word? Is because everyone wants to front-run the market. They want to get ahead of it. They don't want to pay more. They want to pay less. So they look at these things, right? And even though mortgages aren't directly impacted by the Fed, the same factors are involved. Inflation, right? Inflation risk devalues currency, and you don't want to be lending money at 3%. If inflation's at 4%, you lose money. So they're all looking at the same things the Fed's looking at. The Fed just has really good indicators, and they drive these markets.
Between now and September, what factors will most influence mortgage rates on a day-to-day or on a week-by-week basis?
Okay, so we're going to look at, obviously, the rate decision isn't going to be made until the September meeting, which is mid to late September. And it's a 2-day meeting or 3-day meeting. They usually give results at 2 p.m. on that Wednesday. And so that's when we'll know what the Fed decides to do. They're very tight-lipped. We're not going to hear anything. So, but in the meantime, we're going to look at the things that they look at to make that decision, these macroeconomic pieces of data, such as unemployment, right? There's unemployment data that comes out the day this is released on Thursday. Was that the August 27th, I think? And that data is going to show what the unemployment rate is doing, or the unemployment jobless claims are doing. And if unemployment is worse than expected, in other words, more people unemployed, it's going to push the Fed quicker to lower the rates. If unemployment is not as bad as expected, Fed might not do anything. They might not lower the rates at all. They could potentially raise them. I don't see that happening. But we also look at PCE or, core inflation data. And that inflation data, personal core expenditures, PCE, or there's core PCE and PCE. And we're going to look at both those tomorrow on Friday. And if those come in hotter than expected, in other words, more inflation than expected, the market's going to react instantly because everything right now is baked into the Fed dropping the rates in September. And anything that changes that outlook is going to have a profound effect on interest rates between now and then.
Gotcha. So let's assume that the Fed does cut the rate in September. How quickly could that impact mortgage rates that buyers are looking at?
And here's the trick that a lot of people don't understand. They're all waiting for the Fed to drop the rates, right? But a rate drop's already been baked into the market.
What does baked in mean?
Baked in means that the traders that trade these securities and assets, and they've already made decisions based on the Fed, 85% chance of the Fed dropping the rate. So that's why we saw a rate drop. That's why mortgage rates have already dropped a little bit since Friday. Now, if the Fed comes out and says, look, we're not dropping the rates, expect mortgage rates to go up instantly. If the Fed comes out and says, we're going to drop the rates more than you all originally anticipated because we want to get ahead of the market, whatever reason, watch mortgage rates drop further, right, than they are now. And if they announce just the quarter point that everyone's baked into the market, but their language is more favorable toward future rate cuts, rates will also drop. But the biggest risk is that some data comes in between now and then that suggests, hey, we can wait a little bit, and they don't drop the rates at all. And you're going to see mortgage rates go up. So it's that old adage, you buy the rumor, you sell the news. Well, the news comes out in mid-September when the Fed speaks.
Gotcha. So for buyers agents that are watching the market right now, what is the risk of waiting until September versus acting today?
Well, the risk is that, like I said, that the rates actually go up because it's not as big. Maybe they don't do as big of a rate cut as anticipated. Maybe they don't cut the rates at all.
Yeah.
Maybe they signal further rate increases. I don't know. But I haven't seen the data that comes out between now and then, and no one else has. So that data could be, we could be in a great economy, booming, and job creation, low inflation, and there's not a need to cut the rates. But, I know that, a lot of factors, people want cheaper money. It helps boom economies, but there's a adverse cost to that down the road. But right now, if the gamble you take by not locking in or buying the house now is rates dropping, and then, as far as trying to buy a house, you're going to be competing against a lot of other people that said, I'm going to wait till the rates come down.
Yeah.
Because I've heard this over and over and over and over and over again. And people are waiting for the rates to come down. Unfortunately, human nature is to buy high and to sell low. It's why it's the irrationality that create markets.
Adverse to logic.
It's adverse. Well, It's a human emotion. And that's the emotion. I'm not buying now. No one else is buying now. But that's exactly when you should buy because you're going to get a better deal.
Right.
And then when everyone else is buying, that's when you should sell. Yeah. But we don't work that way. There's the FOMO, the fear of missing out. If the markets start running up, people jump in late and they're slow to sell. But that aside, the risk, again, is that the rates actually go up as a result of the Fed dropping the rates, but not as much as anticipated or not dropping at all. You
had mentioned gambling. Are you a gambling person?
I think I've said this before. I am not a gambling man. Now, that's not to say I don't like to play blackjack with a couple $100, here and there.
But you don't gamble with your mortgage.
I don't gamble with my mortgage, and I don't gamble with my business.
Yeah.
And it's calculated risks. And the calculated risk right now says that a rate cut's already baked into September. If I lock today, I'm going to benefit partially from that, but I'm going to lock in my downside as well. In other words, there's not a downside of the rates going up because I'm locked in. The upside you might take a little bit of that off the table. Rates might get an eighth better, a quarter better maybe, unless they announce some drastic, crazy rate drop, which I just don't anticipate. And then, down the road, you can always refinance your loan if the rates significantly improve, but then you've locked in the price of your home. Yeah. And a lot of people think, those people on TV, this isn't even TV, on the YouTubes, on the Twitters or whatever. I'm kidding. But, that these people on social media are saying this because they want me to buy a home because they make money when we do this. That's partially true, but the reality is it makes more sense to buy when others aren't. You're going to get a better deal. You're going to get better concessions. You're going to find the property. There's more choices. And then once the rates go down, everyone floods into the market. Prices go up. Yeah. And concessions go down. Choice goes down. Competition goes up.
Yeah, the word that keeps popping in my head is options. All of your options go away at that point. Yeah.
Right? Like 2020 and 2021, which I hope we don't go back to that kind of a market.
Right.
Yep.
So if you had one piece of advice that you could give to agents that are guiding their borrowers right now, their buyers and borrowers right now, what would it be?
If you're looking for a home right now, not to rush to buy one, but don't wait till rates go down. I think if you watch any social media and any real estate expert, mortgage expert, they're not saying this because they want you to flood in and give them business. They're saying it because it's the right thing to say. Choice will decrease when rates go down. Prices will increase when rates go down. Options will decrease. Concessions will decrease. So if you're on the fence saying, should I buy right now or should I wait? I believe it's a good time to buy. My opinion is it's a good time to buy. Now, everyone's situation is a little bit different. As far as rates go, you're going to lock in right now to a potential rate decrease in September and not have to wait. I think, once that news comes out, it might be a sell the rumor, buy the rumor, sell the news event. Because when the news comes out and it's as expected, you might see rates actually increase in the short term before they go back down, realizing long-term situation.
Sure.
Did that make any sense?
It made a ton of sense. Actually, I wanted to thank you so much for joining us again today and for kind of debunking all of the things that are going on with those big conversations. So
good. Well, thanks. Fun to be back.
Thank you guys for joining us today. If you found some value in this podcast today, like, subscribe, and join us for the next time.
See you next time.